Yo, what's going on, guys? Bexio back, and today we have a brand new video talking about stocks again, and I just wanted to cover a very simple thing involving stocks and investing and making money on the market, but something that's overlooked a lot by a lot of people and how things are going right now, being trading, being a big hobby of people because people are stuck at home, and trading and making money that way seems like something that everybody's getting into right now. And making money on the market seems very easy right now with trading because it's all just exploding right now. But when you talk about making money in stocks and making money on the stock market long term, trading isn't always the answer unless you actually absolutely know what you're doing. Take time to study charts, study companies, study strategies, come up with your own strategy, do all this types of work, which you could dedicate a lot of time to. So for a normal person who either doesn't want to dedicate time to trading like that or doesn't have the time to, investing and understanding investing is the easiest way to go because time in the market always beats timing the market. So that's the biggest difference between trading and investing, is that saying alone right there. Basically, investing and investors have their money in the market and let it ride for years and years to grow, whereas traders put their money in the market and want to pick stocks to explode, and they want to make their money, in a day, in a couple days, swing trade, day trade, hype trade, do all these short-term things. Usually in under a week, they would want to make their money on the stocks. So that method takes a lot more want to go to do it, a lot more studying and knowing what you're doing and things like that. Whereas investing, this is the way you can make easy money in the market, and it's tried and tested. Basically, with investing, you just pick stocks. You can pick big market stocks, big cap stocks, and know that they're pretty safe with blue chip stocks. So things like Apple, Microsoft, Disney, McDonald's, these types of companies that have been around for decades, maybe a century, and they just don't look like they're going anywhere anytime soon. They've been through recessions, they've been through tough times, good times, and they've managed to make it through all of that, meaning your money in those companies is pretty safe. So like Apple is extremely safe, in my opinion. Obviously, do your own research, everything, come to your own conclusion, but I think Apple is extremely safe. Microsoft's safe. These companies have been around. These are also tech companies, so the growth with them is just insane year over year most of the time. So hopefully we continue to see that trend, and it seems like we might have already seen it, them bounce back from this illness dip and just explode from there. So that was huge to see. But that's the way you can easily make money and just grow your money over time. Now, the things people need to understand with investing is, in the beginning, when you start investing, so when you start from $0 and you want to start something, it is hard to put your emotions to the side, because when let's say you buy Apple. What is Apple, like 380 something right now? Let's say Apple's 390 for an easy number. If you buy Apple at 390 and the next day Apple goes down to 380 and you bought 10 shares, you would have lost $100. And you might look at that and go, this isn't worth it. I'm losing money and I don't like that. And you might pull out, which is the worst thing you can do, is sell your stocks at a loss, especially a blue chip stock. So you got to put emotion aside when you're just beginning. And when you put money in, either dollar cost average in, meaning that you don't buy all of your shares at once. So if you had 10 shares of Apple you're going to buy and the price was $390 and you bought 5 shares at $390, and then later in the week it went down to $380 and you bought the rest of your shares at $380, bringing your break even to $385, and then what you would get from there is, if it returned to $390, instead of breaking even, you'd be making money. So that's like dollar cost averaging to protect yourself from drops like that. And if it goes the other way and continues to go up, then you just buy your average up and hope that it doesn't drop. But sometimes you might lose money in the short term, and you have to know your goal for the long term. Knowing your goal is literally half the battle, because if you know where you want your portfolio to be and how much money you want it to be worth, or the growth you want to see month over month or year after year, you're looking for the long term. You're always looking for do you believe in these stocks 2 years from now, that they're going to be worth more than what you're purchasing them at? And if the answer is an overwhelming yes, then you hold it and don't ever even think about selling it. If it's blue chip, if it's newer or an IPO company or something that's not a major company, then you might want to keep an eye on it. But other than like blue chip companies, I say hold it and let it ride, because those companies are tried and true. But you have to know your goal, because if you just go online and listen to somebody like me or someone like Graham Stephan or Andre Jake, Meet Kevin, these like investor YouTubers or anybody else, you could go in blindly, and I don't think these guys really recommend stocks for people to go buy. But if you go in blindly, like if I told you, we're just using Apple again, if I told you go buy Apple, it'll make you a bunch of money, and you go, well, he said it's going to make me a bunch of money, go and buy Apple, and the next week you're down 10% and you've lost hundreds of dollars, maybe thousands of dollars, depending on what you put in. Let's say you've lost thousands of dollars and you don't know your why on why you're in on that stock. So you just sell it. You just say, this guy doesn't know what he's talking about, he's dumb, I'm saving my money. And you sell it because you don't know why you got into that stock. You just listen to somebody to get into it. So know your why and know your goal. And those are the two things that will help you make money long-term in the stock market. So short-term things, can't let them bother you. Control your emotions short-term, and then know your why and your goals long-term, and you will see better growth in your portfolio. You really will if you set out those goals and know the companies you're investing in, know why you're investing in them. So any dips that come, you use it to your advantage to add more to your portfolio instead of panicking and getting worried about losing your money and selling off on companies that you listen to somebody else to get in on. So that is basically all there is to it. Long-term investing is very easy in my opinion. Starting is very hard. Like I said, controlling your emotions, controlling those losses, especially in a super volatile market like this. So if you're just starting and you have $1,000 and you buy blue chip companies, these big market companies, like I said, Apple, Microsoft, Disney, McDonald's, all these blue chip companies, if you're into those and you lose it and next week you're down to $900, don't panic. Set an amount to put in every month. That's going to help you offset your costs and offset your buying prices, so you can continue buying in to these stocks, buying your average down, and then when stuff recovers or things go back up, they don't have to go up as much for you to break even and then start making money on these. So basically, if you're just starting, pick a starting amount and then pick an amount that you're going to put in every month. Every single month, be consistent with that. That's a way to easily grow your portfolio and grow your gains month over month, making sure that you don't just have one set amount of money and then let it ride. That's not really going to grow all of that well. So make sure you're putting money in month over month, pick your own amount. And then once you start getting deeper into your portfolio, you'll see getting into new stocks is less risky, because even if they lose money, your other investments can gain money and then break even for the day. You're talking short term, or start making you money short term, so that you don't have to be worried so much about getting into a new company. But that's basically what you need. Know your why, know your goals, and then control your emotions, and you'll be good. And then always remember, time in the market always beats time in the market. So guys, let me know if you are involved in stocks, how much you like investing, if you don't like it, what your thoughts are on it. And then let me know if you're a trader or an investor. So guys, as always, don't forget to comment, like, subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.